Index funds are the single best investment options for private investors like us to build up wealth. That is because you don't need much money to start, they are well diversified if you choose the right ones, they are low in cost, they are easy to buy and sell, although selling is not necessarily what we're looking for here, and they will perform better than most other strategies. They are very well suited for beginners. If you start there and also stop there, or whether, continue with just that, you will do nothing wrong. So in this video, we'll cover what index funds are, why they are a good investment, how to pick them, and how to buy them. So let's dive in. So what are index funds? An index represents a certain market, or more specifically, stocks and bonds and sometimes other financial assets that are in that market. So the index itself is really just a list. It's just names and numbers. For example, the S&P 500. By the way, whenever it has a number in the name, it shows you how many companies are represented. So here it's 500. Another example would be the Euro Stoxx 600, which then has 600 companies in it. Now the S&P 500 represents the US economy. So those are the 500 companies with the biggest market capitalization, which basically means the biggest companies of the US. There were other indices that, for example, represent the smaller companies of the US economy, or that represent the whole world, like the MSCI World, or growing but not developed economies yet, like the MSCI Emerging Markets. Index funds are funds that bundle together the stocks or the bonds or both, form a specific index. So if the index goes up, so does the fund. If the index goes down, so does the fund. And to buy an index fund, there are two types of products. One is an exchange-traded fund, which is also called ETF, and the other one is an index mutual fund. Now, a little note here, because there are other videos or also articles where people use the term index fund, but what they actually mean is an index mutual fund. Just so you know that the way I use it, there are ETFs and there are index mutual funds, and both of these are index funds. Now ETFs most of the time are passively managed funds. That means the fund is built pretty much automatically because the index already exists. So they already know what to buy into the fund, and that makes them very cheap because there are no management fees necessary. Now mutual funds most of the time are actively managed funds, and they have a fund manager. That makes them more expensive because the staff needs to get paid, and they also might stray from the index if the fund manager decides to do so. Reasons for that could be to make it less volatile or to beat the market. But that is only a rough overview. There will also be actively managed ETFs and passively managed index funds. So the only thing that matters to us is what is in the product, so how many different stocks and is it well diversified, and how much it costs. So why are index funds a good investment? Research showed that the majority of fund managers of mutual funds do not perform better than the market over a longer period of time. So even if your favorite banker tells you that their mutual fund had a 20% return last year, you should still politely decline because they will not have had that same return in the last 20 years. Now, are there investors that perform better than the market, which is also called outperform the market? Yes, there are. Warren Buffett, Ray Dalio, and Peter Lynch would be names that outperformed the market over longer periods of time. The problem is that we can only see that in hindsight. And the chances for us to pick the right one who actually outperforms the market and not underperforms the market over the long period of time is just very, very low. And additionally, those mutual funds are quite expensive. And by expensive, I mean everything that's 1% and more. And it doesn't sound that much, but also costs compound over time, and the longer you invest, the higher this cost is going to be, and it diminishes your returns. In comparison, an ETF or a low-cost index mutual fund typically costs 0.1 to 0.3%, sometimes even less, sometimes a bit more. So especially for private investors like us, those index funds coming around was pretty much a blessing, because now we can benefit from the growth of the market at a minimal cost. And because index funds represent a whole market, it's much easier to diversify. To stay with the example of the S&P 500, we would need tens if not hundred thousands of dollars to rebuild that index. But the cost of the index fund itself is actually pretty low. And by diversifying, we can also minimize our risk, which would not be the case if we had to buy single stocks. And they're easy to trade, especially ETFs can be bought at the stock market, which also explains the name, exchange traded fund. Index mutual funds are not traded at the stock market. You buy them at the investment company or the bank that offers them. So how do you actually pick an index fund? I would recommend to pick the index first. For example, one that represents the whole world or one that represents a certain region. You should take a look on how many companies are represented in the index. For the US economy, there would, for example, also be the Dow Jones, but there is only 30 companies in it. So the S&P 500 with 500 companies in it would be the more diversified choice here. If you go for regions, I would recommend to not only go for your home region, but also for the rest of the world. And the next step would be to look for ETFs or for index mutual funds that track that index. And then you want to consider several factors. Factor number 1 is cost. It's also called TER, Total Expense Ratio. And the TER shows how much the fund costs per year. Keep that number as low as possible. It definitely would have to be less than 1%. Below 0.75% would be even better. Then you can look at the replication method that shows you how the index is actually represented in the fund. There are 3 different types. The first is physical or full replication. That means that the fund buys every single company's stock from the index. Then there is optimized sampling. That means that the fund doesn't buy every company's stock, but they're doing an optimized representation. That's because sometimes it can be difficult to buy the stocks of the smallest companies in the index, for example, because there's not a lot of shares available, or the cost to buy them in would be relatively high. So for the overall performance, it's better to just leave them out. And then there's the swap-based replication. That is when the fund doesn't buy the exact stocks from the companies that are in the index, but from other companies that they think will exactly perform like the index. For me personally, that always felt a bit like buying the pig in a poke, which is why I don't choose them. But that's personal preference. Then you can look at the distribution policy, which is how the fund handles dividends. There are distributing funds, that means they pay the dividends, and there are accumulating funds, which means they automatically reinvest the dividends. And you can also look at the fund size, but I will not go into detail here. I will make a separate video about all the criteria. And then when you found the right ETF or index mutual fund for you, you can write down their ISIN, which is the International Securities Identification Number, or their ticker symbol. That is the way each fund can be exactly identified. Next up is how to actually buy the index funds. So you need to open a brokerage account. And now it's a good thing that you already picked the index or the product, because you can research in advance which broker or which investment companies offers the one that you want. Ideally, there should be a monthly investment plan available, and it should also be free. Look at the minimum that can be invested every month, especially if you want to start with small amounts. And it also shouldn't cost you anything to deposit your money there, because sometimes you need to deposit money there first, and then they can invest from that money. And now in 2023, where the interest rates are rising, you might even earn a little on that deposited money. But in the past years, where the key interest rates were very low, sometimes you even had to pay a negative interest at some banks. So that should be avoided. But maybe they draw the money directly from your checking account, then it doesn't matter. And also look for fees for buying in the index funds. They should be 0 or at least as absolutely low as possible. Then you search for the ETF or the index mutual fund, and then you type in the ISIN or the ticker symbol of the ETF or the index mutual fund that you have already chosen, and then you click buy. You can either do it as a one-time purchase, and or what I recommend is to then also make an automated monthly investment, because that way you don't have to think about it all the time, and you just build wealth while at the same time living your life. I love automation. If you want to take a closer look at the criteria for index funds, you can check out this video next. I hope you got some value out of this. Thank you for watching, and I'll see you in the next video. Bye bye.